Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go over Twitter, see what they're talking about. We're going to mainly focus on the stock market, financial type stuff, commodities, whatever I thought was interesting at that time, and am retweeting. That's basically what we're going to cover in this. And if you guys need any help with anything commodity related or stock market related, check out finding-value.com. I'll become a platinum member. We do have a Discord for the community, and I do weekly question and answer sessions with midweek updates. All right, so let's dive in. I'll give you my financial opinions here. This is Finding Value Finance, so at finding_finance if you want to follow me. And the first thing is, let's show the thread here. It says the Fed since 2020. It says March 2020, inflation won't be a problem. In January 2021, inflation is transitory. Don't worry about it. September 2021, interest rates won't rise until 2024. January 2022, recession is needed to lower inflation. December of 22, disinflation has begun. February 2023, a soft landing is possible. And 2023, banking system is stable. No worries. He says not a single statement was correct. Now, I know some of this stuff is kind of tough to foresee, but definitely some of those statements, I think, were a little bit wrong, for sure. It says, this week we'll hear from the Fed again and receive their interest rate decision. More important than the decision is their outlook and the Q&A segment. All while the regional bank collapse continues. We've got Grady here. He says, been posting big evidence for that something big is brewing for precious metals. We've got gold that broke out against the S&P 500. Gold broke out against the commodity index, the CRB. Silver broke out against the S&P 500. Platinum broke out against the S&P 500. Platinum broke out against palladium. The TSX broke out against the S&P. GDX broke out against the TSX. And SILJ broke out against GDX. So the smaller little guys, when they start breaking out against the bigger miners and stuff, that also means something. The ratios when they break out against each other and how they move and how they rotate is a description of the market conditions. What he's saying is the way that these are breaking out against each other is evidence that something big is brewing in precious metals and commodities in general. What is telling us is that the market conditions are ripe right now for a precious metals move. And those market conditions is fear and a normalization of the curve, the 10-year versus 30-year or the short end versus the long end. That normalization is perfect for precious metals to do quite well. Now, does that mean that we're just going to go straight higher, or do we have more compression, in the curve in terms of inverting the curve more versus more normalization? Normalization, the precious metals like that. In an inverted yield curve, oil, platinum, platinum acts as both, depending kind of on what the conditions are, but oil really likes when the curve inverts and we've got inflation. So we'll see how this works. Maybe we have a good while, some months or whatever, of gold outperforming and precious metals outperforming. And then later on, oil comes on back with vengeance. If we look backwards and we look at what happened in the 2020 March crash, gold rocketed all the way till August of 2020. That was from a March bottom to an August 2020 peak. So that's March, April, May, June, July, and August, about 6 months. From that point on, oil, uranium, and all those other ones really took off in September, October of 2020, shortly thereafter. So that could be a rotation to look for, is precious metals outperformance in the short term and looking at accumulating oil and uranium and these other ones shortly thereafter, after gold really takes off. It says this chart shows how extremely undervalued commodity companies are versus commodities index CRB. Think GDX versus gold. tagging bottom trend line of a 22-year bullish falling wedge with strong positive divergence. Get out of the rat race, lifetime opportunity. So this is CDNX, which is the Canadian commodity companies versus the commodity index. You can see this thing looks like it's bottoming. We also have another trend line that we're basically converging on. So we've got the larger trend line from the big pattern and then a little bit smaller one cutting through. And it looks like we could potentially outperform for the CDNX. We've got Grady again. It says, posted on the breakout 3 months ago, the perfect backtest makes the trend line valid. It is now has a higher high after the breakout. Gold outperforming stock market means historical asset paradigm shift in the making. Very important precious metals chart right now. So this is gold versus the S&P 500. We have a breakout above the 3-year trend line after 3 perfect touches. 1, 2, and 3. We've broken out of that. We did a retest. So that's the clean and clear back test. Higher high, which we're breaking right now after that, which means we are now in a new uptrend where gold outperforming stocks is a big deal, because if that is the case, basically it's telling us we're in a commodity bull market. This happened last time in 2000, I think it was 2002, 2001, 2. And we ripped it after that. We ripped it for commodities. So hopefully those same conditions are coming. It looks like they are. Looks very positive. Patrick also has his chart. I thought this was kind of cool. It says, very rare event unfolding before our eyes. Gold tempting a historical breakout versus U.S. equities. Lots of room to run for precious metals and friends. So we look at this. This is your gold versus the S&P 500, very similar to what we were looking at with Grady. And we've got these periods where the S&P 500 outperforms when this goes down. Gold outperforms on the move up. So right now we are moving and breaking the trend line where gold could outperform the S&P 500. And when we look at that and we look at the custom 7-year stoic indicator, so this is basically a rate of change coming on up, we're coming up breaking this trend line that we've got on that rate of change where silver, gold, oil, uranium, and miners are going to outperform during this time period. That is what it's signaling. So I'm really excited about all this. I think there's a lot of really good opportunities and ways to play this commodity bull market. I'm locked and loaded, and I'll continue to slowly cost average into things that are down. But I think this is the time you kind of just sit and hold when these things start to appreciate. Those moves in oil and a lot of these other commodities were actually part of bottoming patterns for a lot of the commodities. So I think we've got a long runway ahead of us in terms of valuation that it can make against the S&P 500. And yes, the S&P 500 can go down while commodities goes up, and this ratio can change quite rapidly very quickly from that divergence. Here's a quick look at where total inventories are in the US, commercial and SPR versus trailing 5-year ranges. The current inventory balance is 137 million barrels below the minimum range. The question is what the right range is. So we've drawn down our oil inventory versus the range, the 5-year trailing range, and our current inventory level. Yes, we've gone up a little bit here in the short term, but let's look at the total global inventories, and I'll show you what those look like in another picture or graph below. So here's global. So it says global oil and products inventories are rapidly declining. A recent promising change in trajectory for oil markets despite price declines and deeply negative sentiment. So this is the change in global oil inventories. And you can see that we are declining here the past few weeks, months. So we were a positive 5. Now we're at negative 3, 2 or 3 in the change in global inventories. And this is going to draw down your inventories. It says prices fluctuate more than values. So therein lies the opportunities. Says the only question is, will they eventually inflate enough that the debts out there are reduced relative to the GDP such that we are at a sustainable level. Until we are at a sustainable level, there will be a crisis after crisis in the economy and banking system when interest rates are raised. It says if crude was facing a fundamental driven sell-off based on the perception that this was hurting the macro growth outlook rather than just a mass risk-off liquidation, you'd expect to see refined products coming along for the ride. But no, crack spreads up decently this week. Crack spreads are the refining margin. It's the gasoline price versus the oil price. In a fundamental problem type market, the gasoline demand drops and then eventually oil drops. But we're not seeing gasoline drop. We're seeing oil drop and gasoline remain resilient or moving higher. That does not look like a demand supply problem. You make most of your money in a bear market. You just don't realize it at the time. It says using volatility as a measure of risk is nuts. Risk to us is 1, the risk of permanent loss of capital, and 2, the risk of inadequate return. Charlie Munger. Intelligent people make decisions based on opportunity costs. Opportunity costs. That's what intelligent people make their decisions off of. I agree with that. So stocks generally trade between PDP value per share and 2P value per share. The former reflecting current production value in a blowdown, and the latter is a risked view of resource value, usually plus minus 5 years of development, although some get more aggressive. So this is the share price discount to BT 2P 10% NAV. And you can see the companies that he's got. Crew Energy is obviously the lowest on here. And then looking at the share price discount premium to BT PDP 10% NAV. Looking on the right-hand side, there's pretty good discounts in some of these companies. We got Pado Energy, the light blue. Yeah, light blue's Pado, Birchcliff, and Crew are the cheapest in this example. And that is how I value stuff. It's off PDP value of a 10% NPV. Says you really shouldn't ask other people their opinion about stocks. Let's say I give an opinion about an XYZ company. I could change my opinion a week from now and you won't know. You ought to have your own reasons for buying a stock. If you don't, you're going to get shaken out by some event. The stock market goes down a lot, or you read some negative comments. You should make your own judgment in stocks. Good advice. It says, makes me wonder about the reliability of reported oil inventories. These are world oil stock inventories fell slightly last week. And there they are right there, far below the 5-year range, just to show you how low we are in 2023. Surging Chinese demand pushes shipping costs sharply higher. Some energy executives and traders are quenching China's thirst for oil is likely to propel prices later this year. The giant is back. This is China's tanker hiring spree signals oil demand surge. Monthly crude imports by China since COVID-19 pandemic began, and you can see it's surging higher than any time in history this past month. Here's Cuppy. He says, Ponzi's are either expanding or collapsing. They do not do equilibrium well, and they are even more fragile during a soft pullback as it tends to accelerate. So he's just saying how hard it is to control a Ponzi. But that's what I've got for today, guys. That's all I've got. That's what I'm going to share. Oil still looks good. We are just in a fear-driven sell-off. That's basically what the opinions are here. And I still think commodities, looking at it from a long-term perspective, and precious metals look very good. When we break against the S&P 500, it's telling us something. It's saying, look, the paradigm shifted, and commodities are going to outperform, and precious metals. So that's what I'm looking for. That's what I'm looking at, and that's where my money is invested. And if you guys like this content, give me a thumb up, subscribe to the channel, subscribe to the website if you'd like, and we'll catch you later. This is Finding Value.